like to introduce an idea for a new DAC, which is insurance. It can be applied to any type of insurance. If you can define the insurance policy, each DAC implements its own policy with its own terms and conditions for the participants. But before I get into how to implement this insurance policy, insurance DAC, we should really stop and consider, well, what is insurance? The basic idea is you've got a bunch of people, they all put their money into a pot, and one of them is randomly struck by lightning, and that's the person who wins the pot. The maximum you can get out of an insurance plan should be the total amount of money that's contributed to the pot. So the way insurance works today is you have somebody decides to estimate the risk, and they set aside some money in a pot, and they sell you insurance that promise to pay you in the event that something happens. But their promise is really unbacked. The insurance company could go broke because they promised you something more than can actually happen. Now, if they're doing their job right, they're actually charging you more than the risks warrant, which means that when you buy insurance from them, you're overpaying for the risk. So either you're overpaying for the risk and you are fully insured, or you're underpaying for the risk and the insurance company goes bankrupt when you need them the most. And that's the way the insurance works today. I like to change the paradigm here a little bit and design a system that only promises to pay out proportional to the risk, the actual risk, as observed by the system. So any insurance system you have has a certain amount of income, and it's got a certain number of claims. The income has to be divided among the claims on a cash flow basis. If there is a rush of claims all at once, so I'd say it's car insurance, and there's a big winter storm, and there's a whole bunch of extra claims this month, there might be a backlog. It can only pay out claims as fast as it comes in, but eventually everyone gets paid, the long run average. So we're going to design a DAC that arranges for the people who buy the insurance to get paid out on their claims without having to worry about the specific, without having to worry about prices, someone pricing it, holding collateral, all the reasons why insurance is regulated go out the window because it's a DAC and it's unnecessary. So the first step to doing this is to actually separate concerns. With a traditional insurance company, they're holding your money, they're investing your money, they're pricing the system, and they're judging the system. That's a conflict of interest, if you will. Because they have their money, they're going to invest it. If they lose it, they don't care. If they can make an extra return on your money, then that's profits for them, and they don't have to pay you the profits. So there's conflict of interest there. If they misprice it in either direction, they're either pocketing extra profit. Either way, they're pocketing profit. They're charging you for insurance they're not providing you, or they're charging you more than they need to for the insurance provided. And then when they go and they judge the claim, they have financial incentive not to pay you out. So let's solve this stuff. First step is we start with all DACs. All DACs allocate equity. This represents the shares in the insurance company itself. So what did we call this before? The
Mutual Aid Society.
Yeah, the Mutual Aid Society company. So MAS shares. So we're going to call these shares MAS, just like you have PTS, AGS. MAS is going to be the shares in this company. that's going to be the basic framework of all DACs, but we're going to need some unit of value that's predictable. This is a company whose value can be up and down. It's not a very good unit of account. So we're going to steal some technology from BitShares X, and some percentage of these shares are going to be utilized in a market for creating BitUSD. And what I mean by these shares here, they're going to be held as collateral against the short positions that then create the long positions, which are the BitUSD. BitUSD then becomes the currency of the insurance system. Now, the insurance system works like this. If you want to buy insurance, you buy a share in the insurance pool. The insurance pool is not shares in the company itself, but it's a separate fund. This is the pool. For every BitUSD you put into the pool, you are allocated one insurance share. If you have a cheap, if this is car insurance and you've got a cheap car and your maximum payout you need is $5,000, you might buy a couple shares based upon whatever the risk ratio is to figure out, all right, I put $5 in, I get $5,000 out because the risk is 0.1%. But if I'm driving a Tesla, I might need to buy 50 shares in order to make sure that I can get paid out in a reasonable amount of time from the system. So you are over here, and you start out, you buy some BitUSD, so in your wallet you've got your BitUSD, and you take your BitUSD and you send it into the pool. In exchange, you get a balance of insurance shares, INS. This represents the number of insurance shares grows forever. Every time someone puts into the pool, it's an additional share, of course, diluting all the other shares that are in the pool. And this represents a fractional claim on a future award. So the question is, so this BitUSD that's flowing into the pool is also the income. Income into the system. Now, in a properly functioning insurance system, the income should, on average, match the outflows. Either that or the insurance fund is undercapitalized, or it's going to have this ever-growing pool of money that is just sitting there doing nothing. So we're stipulated the steady state, the sustainable state, is that 100% of income needs to be paid out to claims. So let's talk about claims. You buy some car insurance, and you've got these insurance shares here. You need someone to judge that whether or not you've got a legitimate claim. So there's another party to this whole system, and I'm going to call him the insurance adjuster. O-R-E-R. E-R, adjuster. All right. So you take some of your insurance shares that you purchased in the past, and you go to the adjuster, and you say, review my case. The adjuster looks at the facts of the case, it proves that A, the shares belong to you, not to someone else, that the car belonged to you, and that you meet all the other qualifications of the policy to actually qualify. And the adjuster says, sure, all right, I'm going to award you $5,000. So now you've got an award for $5,000, BitUSD, that is due to you. But you can only be paid out that award proportional to your insurance shares. So not just you, but there's a whole bunch of other people that might have outstanding awards that haven't been paid out yet. And so if you've got this pool of all the shares in your insurance fund, a subset of them, let's say 5%, they're the ones that have outstanding claims or awards that need to be paid out. So you look at, well, I've got 1% of the 5%, so I get 1% of the income. Someone else has 1%, and so on and so forth. You've just identified how it is. So this income is split to you and pays down your award until your award goes to zero, because you now have the BitUSD. You've received your $5,000. You know, you go down to slightly less outstanding awards. Of course, by the time you're paid off, someone else comes along and they have their issues, right? So this whole thing is fluctuating, where some percentage is receiving a payout at any given time. And you can look at this and you can say, well, gosh, if at any given point in time 5% is getting a payout, then the maximum expected return, if I put $1 in, I should expect $20 out. So if I have a $20,000 car, I need to spend $1,000 if that's the risk in this system. So you've looked at this whole thing, and there's probably one piece you're wondering about is, how does this adjuster, how do we keep him honest? How does he set the price, determine who's doing what, and who gets to be in the position of making these decisions? Well, just like we can have BitUSD, we can have another market which is collateralized and backed, works just like that, and we're going to call it bit award limit for adjuster A. So this is a bid asset that's a prediction market for how many total outstanding awards this adjuster is trusted with. If no one trusts him, his award limit's going to be zero. He's not going to be able to award anyone anything. But obviously, he's going to be in the business of claims. He's going to be trying to sell a service, so he needs to acquire trust in the system. And so the way his trust works is you go to him, and if his award limit is currently $10,000, he awards you $5,000. Well, gosh, his available limit's now $5,000. And if he fills up to his full amount, because he awards you $5,000, someone else $5,000, he can't issue any more awards. Now here's the thing. All awards, they don't start paying out for at least a month. And they only pay out while his award limit is greater than the awards outstanding. If his trust level falls, his awards no longer pay out, all his claims go back to zero, and everyone who filed a claim with him has to go to another adjuster to get their claim out there. So if he decides he's going to play it fast and loose and write someone a $1 million award on a $5,000 car because it's his buddy, the market's going to say, hey, what's going on with this award? This seems unjustified. His ratings plummet. All his awards in the past month have to be reevaluated, and no one gets paid out. So the adjuster makes money because when you go to him, he charges you a fee for service. So effectively, the adjuster is licensed by the marketplace, which sets his spending cap. And when he gets this license, he now has the opportunity to make money. If he loses this license, his opportunity to make money disappears. And for the really high big ticket items, you're going to need a very high license, which means you're going to have a lot of trust in the system. And if you abuse that trust, bam, you're your ability to charge fees disappears. You're competing against everyone else in the market who is trying to earn trust and get fees. So you might have several different bid assets that can exist here. Now we want to limit, these markets are scarce resources. We can only support so many of them on a chain. So there's a fee charged, a minimum fee required to even enter the bidding, have the opportunity to be priced. And you pay that fee to the network in order to open the market and purchase your license. So what do we have here? We have a self-reinforcing, profit-driven system where all parties have incentive to keep things honest. Competition keeps the adjuster honest. Time delays prevent him from committing fraud with the trust granted him. Market fees in competition keeps his prices down. Individuals have to price the actual risk. Your payout is limited to what comes in. There's no opportunity for more insurance to be promised than the system can actually deliver on. And if you buy a lot of insurance, it might take several months or several years to get your payout if it's an unusual event and you bought a little bit of insurance. But if you bought a lot of insurance, you can get paid out very quickly. So it allows the consumer to price what they need in advance, and you have a system here. The adjuster has to be honest. He has no reason to deny your claim. It's not coming out of his pocket, unless the only thing that can come out of his pocket is being dishonest. If he's dishonest, his reputation goes down, his spending limit goes down, his ability to collect fees goes down, he goes out of business. If he tries to charge too high a fee, well, some other adjuster will spring up and start competing with him. They'll earn the trust, they'll charge lower fees, and so all this will balance out. And someone trying to submit a fraudulent claim, they have to pay a fee to the adjuster. It's kind of like your deductible. Just to hear your case, you separated out buying the insurance from hearing the case. So right now when you buy insurance, you're prepaying for them actually hearing your claim. It's all built into the price. We separated that out. One's the risk and the other's the cost of service. So if you buy the insurance and nothing happens to you, you don't have to pay for the adjuster. But if something does happen to you, it's like a deductible. It's the cost of submitting a claim. You're not going to submit a false claim if the adjuster says this is ridiculous, because you forfeit your fee. That keeps fraud at a minimum. So how would this work? We can do the car insurance example. You could just as easily do a health insurance example, where what's insured can be defined in the social contract of the DAC to say this is for white males between the ages of 20 and 30 that don't drink or smoke. And if you buy the insurance and you go to the adjuster, he's going to say, all right, how old are you? Oh, you're too old, sorry. You don't qualify for the insurance. Why'd you buy it? Or it says, let me see the report from the doctor. Do you have a history of smoking or anything? And if it does, oh, sorry, you don't qualify. So instead of having to assess everything in advance and tell them everything in advance, you just have to prove you qualify at the time you submit your claim, instead of waiting until doing it all in advance and giving up all your personal information. For online disputes, as long as the DAC has a way, or the adjuster has a way, of validating receipts and expenses and reimbursements in a neutral, independent way, you can insure just about anything using this model. So that's our idea for our Mutual Aid Society DAC.